Hello guys, welcome back to the third session of Chapter 5. Now in this session, we are going to look at yields with greater detail. We have known the type of yields, for example, the promised YTM, that's the promised yield to maturity. We also knew the realized YTM. We use those yields to evaluate the bond price, for example, the selling price or the buying price of the bond. Let me ask you this question. So, what is the determinant of the yield? Or what is the determinant of interest rate? Because yield is a reflection of the current interest rate of this bond. We can divide the interest rate into three parts. The first is the risk-free rate. The second is inflation. The last one is the risk premium. Well, these three factors can actually be put into two categories. The first two, actually the outside factors, so they are the macroeconomic factors. And the last one is more like a inner factor. It is the factor that are specific to bond issuers. So the risk premium actually reflects the investment risk associated with this bond. Now, that investment risk of bond is actually determined by the bond issuer's specific characteristic. We know that the discount factor appears in the denominator when calculating the price. So it is negatively or inversely related to the bond price. And we also know that we can explain this negative relationship as with a larger discount rate, there is smaller present value for the future cash flows, such as the coupon and the repayment of principal. And we know that the bond current price is determined by the present value of all the future cash flows. Let's look at the first two elements, the real risk-free rates and the inflation. Now, the real risk-free rates is more like the economic value of money, which is the market-given time value of money. And it is a reflection of the long-term economic growth, which is not gonna go over a dramatic change within short term. If there is anything happened to the nominal risk-free rate, it is not led by a dramatic change in real risk-free rate. For the most circumstance, it is more likely to be led by the inflation. Now, the inflation is a reflection of the short-term economic. It can be determined by the tightness or ease of the capital market. So it can be determined by that, and it is more likely to be the active factor within short term. And also, when we talk about this interest rate of the market or the macroeconomic level of interest rate, we need to pay attention to the factor of the lower funds. If there is an increase in the supply of the lower funds, yet at the meantime there is no change to the demand of the lower funds, then there will be a decrease in interest rate given the significantly larger supply of lower funds. Now there is that. Noticing that all of these factors, none of them can be controlled by the bond issuers. They are the, let's say, the recipient of this turbulence if there's anything happen to the basic interest rate. It is led by the outside factors or the market-wise factors. So very similar to our sense of the systematic risk, though we refer systematic risk in the modern portfolio theory that is used to evaluate the stock price. Well, when we talk about the risk premium, we are actually talking about the risk characteristics of the bond. It is normally determined by two parts. The first one is the most crucial one, is the credit quality. So It is a reflection of the bond issuer's ability to serve its outstanding debt. If there is a larger chance for this bond issuer to not gonna pay its coupon on time and in full term, or not gonna repay its principal on time and in full term, then there is a risk referred as default risk. So if that happens, then the investment risk just soars through the floor. The bond rating in this case can be used as an indication of the default risk of the bond. If the bond rating is high, meaning that there is a larger chance, approaching to certainty that the bond issuers is gonna keep their promise to the bondholders. Now, if the bond rating is low, that indicates there is a higher level of default risk. And bond ratings are normally given by bond rating agencies, which is a knowledge which is public information. You just look for the report and it is there. So the first determinants for our yield of the bond is our credit quality. Now, if there is a higher level of default risk, meaning that there is a lower credit quality, then the investor would demand higher compensation in interest rate to cover them from the uncertainty, from the losing value, from not being able to recover their coupon and principal payments. So that means for a lower rating bond with the high yield, its purchasing price tends to be, let's say, smaller. All right? And then second term is the maturity. Now, we know that for lenders, it is natural for them to prefer short-term loans compared to long-term loans because there is a lot of things can happen within long term. Some uncertainty might happen to the bond issuers, and the investor themselves could also have liquidity needs, so they might need a lot of amount of cash at hand to solve that need. So that means investing your fund into long-term bond could invite many problems. So the investors could asking for a lower interest rate if they decide to invest in the short-term bond to avoid themselves from the long-term turbulence. Now, if the bond issuers want to lure the investors to buy long-term bonds, they need to offer higher returns. Otherwise, that's just not a good deal for the bond investors, right? And also, the credit quality and the condition of the economy, there's actually a correlation. Well, it goes like that. If the economy worsens, so it is in recession, it's full of uncertainty, then there will be an increase in the demand of quality in the bond market. So investor would drop risky bond and shift their investments to quality bond. This will bid up the price of quality bond. All right, so they will bid up the selling price of the high rating bond. So in this way, the price difference or the yield difference between low rating bond and good rating bond actually becomes larger. So the difference between different bond across different categories of quality actually referred as the yield spread, which could be larger when the economy gone into a less desirable condition. Okay. All right, let's look at some of the important relationship when we determine the price of the bond. The first one is the one that we have talked about so many times. So that is the bond price have a negative relationship with the yield or the interest rate level. Well, we say the interest level appeared in the denominator when determining the bond price. So, of course, these two are negatively correlated. And also, a higher discount rate indicates lower present value for all the future payments, which determines the bond's current price, bond's current value. So, That is understandable negative relationship. Now the second one indicates that for a given change in yields, the longer maturity bond post larger price change. Thus, the bond's price volatility is directly related to maturity. Now, let's bring out the pen here. Now, when we talk about the discount factor, we always need to consider that with the timing issue, which is reflected by the number of investment terms. Longer maturity have a large number of investment terms. So that means the power of this discount function goes up. If the power goes up, the whole denominator becomes even larger. It accelerates the level of discount function. So that is why when there's a change in yield, a larger value for n, a larger value for the number of investment terms actually lowers the price even more, indicating a greater level of interest rate risk. Now, the third one is the maturity effect of bonds. Don't worry about that. We will look at this relationship with greater details in, 2 slides later. Now, the next relationship is that we say the price movements resulting from the equal absolute increase or decrease in yields are not symmetrical. Now, here we have introduced the price yield curve once again. We can notice that the measurement in yields is actually 2% apart, right? So let's observe a case of an increase in yield. Let's look at the first 2 units and the last 2 units together. For the first 2% increase to 4%, we will observe a decrease in price, bond price, about this much. So this is a price drop when there is an increase in yield. Now, for the last 2 unit change, we can see that this leads to a relatively small price drop, which is only about this much. Now, this is what we mean by the equal absolute increase or decrease in yield are not symmetrical. See, this last 2 unit change lead to a much smaller price drop compared to when the interest rate is increased from 2% to 4%. Now, let's look at the relationship backwards. If there is a decrease in yield, there will be an increase in bond price, right? So we look at from this direction. Now, when there is a drop in interest rate from 16% to 14%, the price increase is also very small. And for here, the price is led by the change in yield from 4% to 2%. That means there will be an increase in the bond price still by this much. And we can see that the equal level of interest decrease, these two, both 2%, lead to different level of price appreciation, that's price increase, when the yields are at different level. However, we can also noticing that if we decide to draw this line even longer, the line will be flat out at extreme level of yield. This indicates a negative marginal effect for the negative relationship between price yield. It is still, decreasing if there's an increase in yield. Now, the last function is the coupon. We say that high coupon rate possess smaller interest rate because if there is a change in interest rate, high coupon rate would present a smaller level of percentage change in the bond price. Well, let's look at the function of bond price once more. So it is given by the present value of coupon plus the present value of principal. Now, if the cash flow from coupon is small, so that indicates a larger proportion of cash inflow are actually given by the principal, which will only be paid at the end of the maturity, which is a long time from now. So that means this function, which presents a larger proportion of the total cash inflow, actually have a greater interest rate risk because it is very far away, right? Because it is being put at the end of the maturity. So it has that negative effect coming from this discounting factor, its power. So the present value of coupon is in the form of annuity. Annuity compared to a single time this function, compared to the premium, actually, these two present different level of interest rate risk. This one is more sensitive to a change in interest rate compared to this one. So when we have lower coupon payments, we give larger proportion of cash flow to be determined by the present value of principal. And principal happens to be the part of cash inflow that are very sensitive to change in interest rate. So that is why we say when there is lower payments of a coupon, the bond price are very sensitive to a change in interest rate because a great number of its cash flow's current price is determined by the principal, and principal is a risk sensitive or is interest rate sensitive factor. However, if we have a high amount of coupon, that means we have smaller proportion of cash flow to be determined by the repayment of principal. Then that means we are giving less weight to a part of cash flow that are very sensitive to interest rate change. So that's the coupon effect of the bond. High coupon bond have a lower interest rate sensitivity. Now, let's look at the maturity effect and the coupon effect with some real numbers. We say that the longer maturity bond experience the greater price volatility. However, this not desirable relationship tends to fade away when the maturity is long. Now, let's look at the example here. So that is, we have 4 types of bonds. And the term is 1 year, 10 years, 20 years. So each 10 years apart. And there is a change in the discount rate from 7% to 10%, indicating an increase in yield, which lead to a decrease in price. Now, other things remains the same. For example, the coupon rate and the face value of the bond also stay the same. And we can tell that when we only have 1 year of maturity, for a 3% increase in discount rate, the bond price drop by 2.9%. Now, when the maturity becomes 10 years, we can observe that the price drop in bonds becomes much larger. It becomes 18.5%. For the next 10 years, for a 3% increase in discount rate, the bond price drop by 25%. Now, we can tell that when, firstly, the bond yield gone through the first 10-year period, the drop in price is about, let's say, about 15%, right? However, it comes to the next 10 years, the price drop becomes 13.2. Is it? No, sorry. Now 13. Sorry, it's 7. That's elementary math fail here. Okay, 7.2%. 7.2% for our price drop. And then lastly, when we've gone through the third 10 years, the price drop is 28.7, which is only 3% when we have gone through the last 10-year extension in maturity. So we can see that even though we are observing a larger extent in price drop when the maturity becomes longer, the magnitude with every 10 years extension in the maturity actually lead to a decreasing rate in terms of the price drop. See, for the first 10 years, the price drop is most crucial. For the next 20 years, 7% still crucial, but much smaller compared to previous session. And lastly, with a 10-year extension, the price drop is about, well, just 3%. So that means the negative effect between the maturity or sensitivity of maturity holds towards the interest rate risk actually diminishing when the maturity of the bonds becomes extensively longer. Because 30 years of bond, it is a very, very long life bond. So that is the maturity effect. We can, well, let's just see the difference between the 20 years and 1 year, right? The interest rate change are both equal to each other, just 3% change, 3% increase. However, the price change, well, this one is almost 10 times of the 1 year's maturity bond. So that's what we say, a long-term maturity bond possesses high level of interest rate risk. And that interest rate risk tend to fade away when we arrive at extreme level of maturity. Now, let's look at the coupon effect. The coupon effect is just as what I have talked about in these slides. All right, so let's review them by the hard factors. Now, the data here presents the effect of coupon rate on the bond price volatility. We still change the interest rate from 7% to 10%, so this would still be a price drop. However, the coupon is changed from 0 to 3 to 8 to 12, so an increase in coupon payments. And we say that coupon payments possess less level of interest rate sensitivity compared to the repayment of principal. So we say a higher level of coupon would lead to lower sensitivity to interest rate change. Now, let's see if our conclusion tests out. See, from 0% to 12%, with an increase in discount rate, there is an decrease in the bond price, and the price drop level is nearly half of the price drop when the bond does not pay any coupon. However, for a 12% coupon rate, the price drop is about 20% less, right? About 20% less. So that is the power of high coupon. It lowers our interest rate sensitivity. Now, we need to pay attention that when we change the coupon rate from 8% to 12%, remember 8% is a quite substantial level of coupon payment, and 12% coupon rate is also a very high coupon rate. Now, with a 4% increase in the coupon payment, we actually only observe 1.6% of, let's say, price protection. This 4% increase in coupon only saves us from the price drop of 1.6%, which is much lower compared to the 4% coupon increase. So that means the protection from coupon actually also fades away when the coupon arrives at a very high level. So that is very similar marginal effect compared to the maturity effect. So it is decreasing slowly. And also, this can show our escape from the interest rate risk by lending the help from the high level of coupon. So that is the maturity effect, that is the coupon effect, which all determines our interest rate sensitivity. And why is that important? And can we quantify this interest rate sensitivity? Well, wait for the next session to find out. All right, see you next time. Bye-bye.